or get you through some of the main events driving commodities, especially oil and precious metal prices over the next minutes. Just a little bit of facts. I'm not sure how familiar you are with Saxo Bank, but we are a Danish registered company, bank. We employ 1,500 people around the world. We're very international. We have lots of languages, lots of multicultural in the bank. We got 40 languages spoken at our headquarters in Copenhagen, so it's a great international environment to work in. Our main task is obviously to provide liquidity or provide access to global markets. So we have around 170,000 trades in FX, foreign exchange, every day, but we have stocks and commodities traded as well. Our daily average turnover is around $12 billion, and every single day we receive 5 to 6 billion prices coming into our system from across these 30,000 different products that we trade. So it's a very busy machine, but it's coping very nicely. So this is what we do, and what I do is I focus on commodities. I've been doing that for a number of years, both primarily from a trading background. I was working for a fund for many years in London, so that's where my interest for commodities coming from. But let's get started, because we have at the moment a little bit, what we're starting to see now is the typical that the best cure for a low price is a low price. Because what a low price does, it stimulates demand, and it also forces producers to cut production if it becomes too expensive to produce. And that's really what we're seeing at the moment, that we have had this major sell-off in commodities. This is an index covering 22 of the biggest commodities in the world. It looks obviously a very bit like oil prices, because oil is a key part of this index. But since the beginning of the year, we've seen a bit of a turnaround. So we are maybe seeing light at the end of the tunnel, primarily, as I said, because we are seeing the adjustment starting to take place in terms of supply being reduced and demand starting to increase. It's also being helped by the fact that the dollar, up until recently, has been weaker. And when the dollar weakens, it tends to have a positive impact on commodity prices. So that has also been helping the market during this past few months. But we're starting to see a little bit of a challenge now, because the dollar has been rising here in May, and we're seeing that impacting some of the different commodities, especially precious metals. But up until now, it has been quite a strong year. We see precious metals has been one of the best performing sectors. The grain markets has been doing quite well as well. So we are seeing a positive performance across commodities as a whole. And what this is doing is it's starting to attract some interest again from investors. We have seen hedge funds and money managers around the world getting involved again, quite aggressively. Some of that is obviously speculative, so if the price is going up, they want to join in and they buy in expectation that it will go higher. And we can see the big change we had just over the past few months, that just at the beginning of the year, we almost had a short position. So funds were actually net selling of commodities, energy, metal, agricultural, and since then we've had quite a substantial increase. So hedge funds now are holding the biggest position since 2014 across the different asset class of energy, metals, and agriculture. But let's look at the oil prices, because that's obviously really a big key for the whole region and for the global economy. Thank you very much. For the global economy as a whole, we all have been witnessing these tremendous movements in the market now for the past few years. And what's different this time round is, compared to the collapse we saw back in 2008, is really the global financial crisis back then triggered a demand shock. So almost overnight, demand just basically fell off a cliff. Demand disappeared, and that drove the price down very, very rapidly. This time round, it's been more driven by a supply shock. So we come into a situation where we had too much supply. And that supply was really the reason why we had this increase in supply. I think it's well known. We've seen production starting to increase from non-OPEC producers, especially in North America. But the reason why that became possible was obviously the 3 years after the Arab Spring, where we had very high oil prices. High oil prices helped bring along or help along these technological improvements, which made production from more expensive sources possible, and that's what we were dealing with when we came into 2014. And the supply shock is more difficult to cure than a demand shock, because what do you do as a producer when you have a supply shock and the price is falling? You want to keep your revenues as high as possible, so you increase production if it's possible. So while the market's been selling off, we have seen production especially from some of the OPEC producers increase, and adding to this the additional supply from Iran this year, we have obviously had a situation where supply has been continued to be rising within OPEC, but falling outside OPEC. And we are now just starting to see the market getting into more of a balance, and we can start to look for a market that will stabilize. So what has actually been going on since we hit a low back in January? Because back then, suddenly we were coming down to $30 a barrel. We started hearing Goldman Sachs talking about $20, and suddenly that almost became the focus that oil is going to collapse further. It's going to go down to 20. So we've kind of had 3 stages in the recovery so far. We've had what OPEC did extremely well together with Russia was using verbal intervention. So when they talk about production freezing back in February, that really triggered a turnaround in the market. The market was worried that they were going to cut production or at least show some initiative. And that really helped the market to kick off the recovery over the following months. And that was then followed by the real change, and that was the fact that high-cost producers in North America, in Canada, and elsewhere, they started to cut production. And this is what we have seen, and that's been the real cause for the stabilization we've had in the market now for the past few months. You can see on the black line, or the dark line, that production in the U.S. now has fallen by around 800,000 barrels since last summer. In the meantime, the number of the oil rigs in the U.S. has fallen dramatic. Excuse me. And that's leading us on to the events that we've seen so far this May. Supply disruptions coming from all over the place, especially from Canada and Nigeria. And you can see it's not really working, but you can see the Canadian wildfire here at the beginning of May, how that really triggered a big spike in the supply disruption. So when you suddenly remove 1 to 2 million barrels a day from the market, then obviously the rebalancing is speeding up very fast, and that's what we have seen over this past month. Obviously, some of that supply will come back over the coming months, so that also means that the support from these disruptions will not continue indefinitely, and that will obviously potentially create a bit of a challenge later in the year for oil prices. And that's really the question, if we've seen too much too soon in terms of the oil price rallying, because what we have seen over the past few months is that while the red line, which is the spot crude oil price, has been going up towards $50, we have obviously also seen oil prices out in 2017 move higher. And we have a bit of a magical level right now, which is $50 a barrel. There's a lot of talk that above $50 we will start to see producers increase production again, especially in the US. And so that's really led during this month of May here, we've seen the front end rally, but the back end has not really been following in the same speed, because we're seeing selling coming in from producers starting to hedge their production. And that could indicate that we have hit a little bit of a roof for now in terms of how high prices can go at this stage before the recovery will continue later on. The improvement in the market is also seen in the US market. These are some of the stock prices of US shale oil companies. You can see we had some of them were down 60% when we hit the lows back in February, and since then we've seen a general recovery in the market up until we are generally up on the year now. But where it's really where we've seen the biggest change is the credit worthiness of oil producers. Back in the beginning of the year, if you were a high-risk U.S. oil company, you have to pay more than 16% above U.S. Treasury yield to fund yourself in the credit market. And obviously a lot of the expansion in the U.S. market is based on debt. So that was really creating a lot of nervousness also in the stock market. That's why we had the stock market collapse back in January. Because with all this, with credit, with the worries about credit defaults in company levels and also to a certain extent on country level, that helped drive the nervousness in the equity markets. So back in January, at trading desks around the world, stock market traders were not following the stock price, they were following the oil price, because the oil price was really setting the tone for the price developments back then. Since then, the market has started to rally, and the credit risk has collapsed, so now these days it's down to around 9%. It's still high historically, but at least it is improving. And this combined with the fact that prices is back above back close to $50 is starting to have this potentially positive impact on US producers. But we actually will need the oil from non-OPEC producers within a few years, because we have to realize that we've seen billions of dollars worth of cuts in production or in exploration costs now over the past couple of years since 2014. And one thing we know for sure is that global demand for oil will continue to rise for at least the foreseeable future. At least the next 10 years out, demand will rise every single year. So with the wells running out, we constantly need to find new oil, and that is obviously what is being put at risk right now, because the price has been so low for a while now that it has become increasingly uneconomical for some of the high-cost producers to look for oil. So we are moving towards a situation where we will, instead of having a supply surplus, we will move towards a deficit over the coming years. And when that starts to happen, we will need to see oil come back from U.S. producers, and that will only come back if the price moves back above $60, probably in the $60 to $70 region. So that is probably what we should be looking out for over the next couple of years, that we will continue to see oil prices generally rally, move higher. Whether it can make it much above 70 depends on other factors, supply shocks or geopolitical events and so on. So the future looks, in terms of price development, looks obviously much improved now than it did just a couple of months ago, but it will take some time for this to unfold. Meantime, we are obviously also seeing big attempts being made in the Gulf states to continue to improve or increase production. One thing is to maintain the market share. If the overall demand globally goes up, then obviously in order to maintain the same market share, GCC and other OPEC members also need to continue to increase production. And that's what we're seeing happening at this stage. So while a number of rigs are being cut around the world, in the region, number of rigs are actually going up, and that will ensure that there will be an increase in production over the coming years. So oil will be found, and as I said, if it reaches a certain level, we will see quite a big impact on, or big return from the fracking industry, and that will help stabilize the price probably somewhere up in the $60 to $70 area. So obviously, because we are very much focusing on trading conditions, we in my daily job in Copenhagen, where we publish reports about what's going on in oil and gold and some of the other commodities. We do obviously keep a very close eye on how investors are positioning themselves, because we do know that a lot of the volatility we have in oil markets, yes, some of it is created by geopolitics, supply disruptions, but quite a bit of it is also generated by speculative flows. Speculative flows can obviously both impact the market to the upside and to the downside. And what we're finding at the moment, it's a little bit, there's a lot of different lines here, but just focus on the gray area. We can see this is the net long position in oil, and we can see we had some big speculative interests building in previous years, and right now it's very high again. And if we combine what we're seeing in Brent crude, which is basically at a record, there's a record long position in Brent crude, so fund managers and investors around the world expect oil price to go higher. That translates into at the bottom one, if you combine all the positions speculative at the moment, there's 650 million barrels currently held by funds around the world speculating in higher oil prices. That's obviously good as long as the market continues to go up. If we see a correction in the market, there is a risk that we can see a correction which is deeper than what would otherwise be justified from a fundamental perspective. So we have to keep a very close eye on the developments within these positions, because we do see sometimes that when we have big down moves, that's correlating to big movements in the price as well. So at the moment with the market almost priced to perfection, a lot of investors looking for higher prices. The risk is in the near term that we could potentially see the market just settle down, and we could see a bit of see some profit taking being taken. In the U.S. market, from the oil perspective, we follow the U.S. market very closely because oil data is sometimes difficult to get. From the many producing countries only produce data once a month, and quite often that data is delayed. So US is really the only place where we have weekly data, where we have a weekly, where we can take the temperature on the oil market. So that's why we follow the developments quite closely there. And even though US is only a small part of the global oil market, if there's any major changes happening there, then it tends to also impact oil prices for the global oil price. And I've just put up a few here, and we can see on the top left that inventories in the US are record high at this moment. It's the highest since 1930, and that obviously needs to be brought down. We are starting to see now the seasonal shift, so we are starting to see a little bit of a change now, and that will probably continue now for the coming months, because it is the time of year where US refineries, they increase demand for the summer driving season. American motorists are driving more now than they've done in many, many years, so the demand for gasoline is very strong. But probably the most important one is the red line on the top right, the production. As long as that continues to go down, then the market will continue to be supported, because we will see it will help stabilize also bring down the inventories in the US. But what we have this year, which we didn't have last year, is we have quite high inventory levels of gasoline already. So if we don't see the driving season being as strong as expected, then we're ending up with very high gasoline inventories, and that may mean that refineries may not demand as much crude oil as they normally do, and that could help keep the price under a bit of pressure. So again, we may have a bit of challenge over the coming months. So what are we expecting for oil? I think at the moment we are, let me just take the chart first, because we've seen this very strong rally. This is a weekly chart from the lows, and we're now starting to find some resistance just above the 50 level. And I think that's probably going to be as far as we can go at this stage. And in the near term, I'm looking for a correction back down to probably the 45 area. But I'm not seeing a reversal in the market. I'm not seeing much lower prices, because the rebalancing is well underway, and that is going to keep the market supported. But for the remainder of the year, we may see some weakness over the coming months into the autumn, and then as we move towards the end of the year, we will see the market move back up towards the $55. That's probably as far as we can get this time this year. This year. I've written some of the highlights that we have the bull and the bear So the bull is what can happen to the upside. I've written a few of them, but we are seeing the balance now starting to improve between supply and demand. So that will imply that the price will eventually have to go higher. Supply disruptions may become longer lasting than what we've seen so far. Geopolitical instability is always a factor we have to take into account. We still have some strong momentum from investors. That could also take it higher in the near term. And then once the market is in a proper balance, the focus will shift totally towards the fact that we've had so many cuts in investments, and that will impact future production, and that will be positive. So these are the upsides, but we could also see some downside potentials or risks. If US production slowdown is reversed, i.e. now that we've seen the price back up to 50, will that be enough to bring back production, or at least slow the production in the US? That is a risk over the coming months. High inventories remains, so before we can really start to see proper improvement, we need to see those inventories around the world being brought down. They are probably above 1 billion barrels at the moment, so a lot of extra inventories that needs to be reduced. And we are seeing probably a bit of a market share battle between Iran and Saudi Arabia, which means that if Iran manages to continue to increase production, Saudi Arabia will probably follow them. And if it happens too soon, it may happen too early during this recovery stage, and that is a bit of a potential risk. Some of the others is one of the key demands in recent years has been China. China, just like the OECD countries, wants to build up a buffer of strategic reserves. OECD countries, they're holding 3 months worth of imports minimum, and in order for China to build 3 months worth of imports in strategic reserves, so they have a buffer if there's a geopolitical or for any reason that they cannot get oil. To build that will take many years to come. But so they're building storage capacity all the time. But some of the recently built capacity is starting to fill up. So we may see Chinese demand slow down in the short term. And again, that could have a negative impact. So a lot of different things, a lot of different both upsides and downsides. And that's obviously helping to create or make this oil market incredibly difficult to predict anything about, because the big movements we've seen over the past few years here, no one saw that coming, especially not when it broke 100, and the fact that Saudi Arabia wouldn't support the price any longer. We can see now why they couldn't, but we can see how the volatility in the market is very high. And when you have so many unknowns, and you also add into the whole equation politics, then it just basically means that it can go quite often a lot further than otherwise is warranted by fundamentals. So before we leave oil, I'm just going to mention a little bit about the OPEC meeting coming up. OPEC has, I think, has been a bit lucky because they have bought themselves time. Because OPEC at the moment as a cartel is having some deep trouble. We've seen OPEC meetings where they failed to reach any agreements. We've seen the Doha meeting where the open animosity between Saudi Arabia and Iran was laid bare. And that's going to be, and that's obviously a challenge for OPEC. So OPEC needs some space, they need some quiet times. And I think the fact that we have now seen the oil price return to $50 means that this meeting is not really that relevant. So instead they may have the opportunity to sit down and stare each other in the eyes and see if they can actually discuss the markets without having to show the world that they disagree on many things. So no decision is required from this meeting. We will obviously watch the new Saudi Arabian oil minister, how he performs. But I think at this stage, rebuilding the reputation is probably the priority. And also, all this talk about freeze, it is amazing because they have talked about freezing production, and obviously the market reacted to it. But if you look over here on the right, OPEC is now producing more oil than they did since 2008. So they have, while they've been talking about freezing, they've actually been increasing production. You can say, luckily, they have been able to, because at the same time, production has been falling elsewhere. But it just indicates that all the freeze talk was more an attempt to try to hold the market without having to do anything in terms of actually cutting production. And they succeeded. So you may see, even though it's very, very painful at the moment, with most of the producers needing a much higher price than where we are now, we are starting to see light at the end of the tunnel for the oil market. So as I mentioned, 45 to 50 now over the coming months before we move back up towards the 55 level at the beginning of or at the end of the year. I think I'll leave oil for now. I will be around if anyone has any questions, either outside or just come to me if you have any questions, anything was unclear. But let's go to gold, because while oil is an important way to attract revenues, gold has been very important ways to invest the revenues that you have received from various incomes. And before I start talking into this, gold has been obviously up until the last couple of weeks the very, very big surprise of 2016. When we started the year, the attitude was that the dollar was going to go up, that US interest rates were going to go up, and the gold was going to go down. So there was really no, there was a lot of negative news about gold at the beginning of the year. And it basically meant that when we, just a few weeks into January, had some big changes. We had the collapse in oil price, collapse in stock markets, a change in the attitude from the US Federal Reserves in terms of raising rates. Then suddenly gold was under-owned, and it went from being under-owned to probably slightly over-owned over the following months. There is a lot of focus right now on US rate hikes and US interest rate policies. It is, of course, important, but I think probably the most important thing is what we're seeing on this chart here. The quantitative easing that we're seeing across the world, in Europe, in Japan, elsewhere, has driven down the yield that you get on sovereign bond debt to very much below 1%. And in cases in Europe and also in Japan, you get negative interest rates on your bonds, on your safe haven bonds. Two-thirds of global sovereign debt at the moment is trading at 1% or lower. That basically means that if you are a fund manager, an investor, and you're looking at safe investments, and you're looking to buy a German government bond or a Swiss government bond, you have to pay for it. You're buying the bond and you have to pay for it because it's a negative interest rate. That is a big change, and it's obviously it's almost difficult to comprehend that you're buying something and you have to pay for it. But that's the situation right now, and that situation is not going to change anytime soon. And that means that we have seen real money buyers, we have seen real money managers move back into gold over these past few months. And the World Gold Council, back in their latest reports, basically said that it's not only investors looking for diversification. Central banks are also continuing to buy gold. We have seen selling from Venezuela this past month, but that has been offset by buying elsewhere. But I think this is my key message at the moment. There is a risk of a stronger dollar in the near term because of the US interest rate policies and the uncertainty about how much they're going to change. But I think at the end of the day, this is one of the key messages in the gold market right now. But let's look at some of the movements we've seen taking place during the first quarter, and also up until recently. We've seen the biggest investment surge on record in gold. So when we look at gold markets, we quite often look at paper gold and physical gold. Paper gold is what you as an investor buy through an exchange-traded product, through a futures market, or through an index, or through a fund, whereas the physical gold is more, it's the bars, it's the jewelry. But the paper demand has been incredibly strong. A big surge, 364 tons just in ETFs has been bought year to date. And what was interesting as we came into May, we can see these two crosses. While the price of gold was going down this month, we've actually seen demand for gold continue to go up. So investors have been buying gold even though the price has been going down. That indicates some kind of price, that investors are less price sensitive because they're looking longer term. So it could indicate that quite a lot of money we've seen moving into gold is longer term investors coming back. But what's creating the volatility, as we've seen in oil, is the speculative funds, something like hedge funds and money managers, especially hedge funds, because they started the year with a record short position, the gray area down here. So they went from a record short, and then there have been non-stop buyers all the way through into the beginning of May. And you see that they've been reducing their short positions and they've been increasing their long positions. To that extent that we just at the beginning of the year, just in 1 week, they increased their position by 27. And that was all that trading was happening above 12.50 on the price. Now with the dollar starting to rally during May, and with the interest rate expectations in the US changing, we have seen that the price of gold come down again. And we've seen a lot of these latest positions come underwater. So these guys are not long-term investors. They are not married to the position. They are looking for any change in the technical outlook or the fundamental outlook, and then they have to reduce exposure. And that meant that just last week there was a 26% reduction. So there's some big swings going on in the positioning at the moment, and that's, I think, probably the main reason why we've seen the weakness in gold. We're not seeing investors starting to be negative. We're just seeing positive investors maybe having become too positive, and they have to adjust their exposure down. And that's most of the selling that we have seen now for the past few weeks. But if we compare paper demand, as I mentioned, which is investment demand, and jewelry demand, we have seen a weak quarter for jewelry demand, because jewelry demand is obviously dependent on economic growth and currency movements. And what we haven't seen in India, for instance, we've had some weather-related. We had drought in India. That's reduced farmer incomes, and that's reduced demand for jewelry. China, we're seeing also that they have become less. They become more price sensitive. So with the Chinese yuan weakening, and with gold in the price in dollars going up, then obviously the price in yuan has been going up quite strongly as well, and that has deterred some physical buying in China. But let's look at the numbers. If you combine the red and the blue over in the top left, that's ETF and futures. We've seen during the first quarter 800 tons of gold being bought. Against that, jewelry demand dropped by 115 tons. So it's not really that relevant at this stage. Jewelry demand is important if the market continues to fall, because when the market falls, you start looking for reasons for it to stop falling. No one really wants to know about. And that's when jewelry demand does become interesting. Take a look here, if you look at some of the major miners, this is as the GGX is a weakened ETF that's tradable, help the major mining companies in gold. You can see why gold at this stage was up 17% this year. Another interesting thing we can derive from some of these numbers that they've been able to increase profitability because many of these gray charts I'm showing here, these are speculative data and positioning by commercial traders. This data is available because it's all derived coming from the US futures market. So these are the positions held by large either producers or speculators in the US futures market. So this is the gold futures traded on COMEX. So while we're seeing a big long in the speculative position by hedge funds, we also quite often, if you have a long, you also have to have a short. And the short position is the commercial guys. These are the guys, the miners, who needs to hedge their forward production. So they're selling into a market in order to hedge their production. What we have seen now for the past month, while the price of gold has been falling, we've actually seen some very interesting developments. First of all, we've seen that short position, the gray area, has been reduced by 42%. So the market has been coming down, but they have actually started to buy back some of their short positions. Excuse me. And the interesting one is actually the blue line. That's the long part out of the net. So the blue line, over the past month, they have actually been buying. And that's quite unusual. If you are a hedger, then you are a seller. You're selling the market. So for these guys to actually having increased or doubled their long position over the past month, when you are a natural seller in the market, that does indicate that they are potentially seeing something in the mining sector, in the physical market, that is indicating to them that they don't think the price is going to fall much from here. And we'll see over the coming weeks and months what's going to happen. But at least it is an unusual situation that a producer and a merchant who are natural sellers, that they are actually buying into the market at the moment. The negative drivers that we have seen for the past few weeks, we obviously cannot ignore them. Two things. First of all, the bond yields in the US, I'm looking at real yields, so this is yields minus inflation. We have seen the yields been starting we saw that fall, so this is inverse over here. So we saw that the yield, as the yield fell, support for gold increased. And now over the past couple of weeks, with the change in outlook for US interest rates, we've seen bond yields go up, and that's having a negative impact on gold price. The dollar is also one we cannot ignore. The dollar was weakening. Again, this is inverse here on the right-hand side. The dollar was weakening throughout the first 4 months of this year, up until recently, where we've seen the dollar strengthen a bit. So these two are obviously key drivers in the short term, and that's where we're seeing the inspiration for the current market movements coming from. But we do expect that these will not be the main drivers if we look further down the line. If you're an investor in gold, you may also be looking at gold miners. Gold mining stocks has been phenomenal so far this year, because they came into 16 completely depressed because the price was low of gold. They were having too high costs, and it was just a sector that no one really wants to know about. But if you take a look here, if you look at some of the major miners, this is the GGX. It's an ETF that's tradable of the major mining companies in gold. You can see why gold at this stage was up 17% this year. This sector has risen by 73%. They've been able to increase profitability because their wage cost has been going down. In local currencies, we've seen many local currencies come under pressure against the dollar, up until recently, that is. So that's bringing down the wage cost, and we've seen falling energy prices. That's bringing down the cost of diesel. These are two of the major costs involved in mining, and these have both been coming down. So suddenly mining companies have become much more efficient. Their costs has come down and the price is starting to go up, and that does result in a much better market performance. They're also bringing down debt at the moment, because while the market was falling, they had to take on more and more debt to stay alive. Now they can start to repay debt, and that's obviously making the stock price even more attractive. And also they have become better to extract metals out. So these days, on average, these are data from Bloomberg, on average they extract 1.25 gram of gold out of each ton of material. And that's just also an indication what a big industry that is. To get 1.2 gram of gold, you have to mine 1 ton of material. But just look back in 2012, it was 0.9 gram that you got out of 1 ton of material. So it's a lot of diesel, a lot of engines, and a lot of workers is required to get that 1.25 gram out of the ground. And that's why when these costs come down, then these guys do very well. So that has been the alternative alternative way to look at gold investments. Silver has also become increasingly popular this year. Silver is a bit of a strange thing because silver is semi-precious, so it takes some of its direction from industrial metals, because probably 50% of demand for silver is derived from industrial use, and the other 50 is investment and jewelry and so on. So what we've seen, we actually now are starting to see demand for silver rise, especially the whole solar industry and the whole electrification of the world, because we are moving much more towards electricity, and silver is a fantastic component when it comes to that. But the solar panel industry will continue to rise very strongly, and they need silver. And when you at the same time have a slowdown in production of some of the other industrial metals, then you also have a slowdown in production of silver, because quite a big portion of silver is derived when you're mining for copper and zinc. Silver comes out automatically as well. So when your production slows for some of these, then you start to have that does have a positive impact on or slowing down the supply of silver. So after continued to underperform silver or underperform gold since 2000 and I think it's 11, yeah, we're now starting to see silver outperform. This is the gold-silver ratio, which is a different way of trading precious metals. It basically reflects the number of ounces of silver that needs to that 1 ounce of gold is costing. So when we peaked early this year, we were trading above 80. So that meant back then you needed more than 80 ounces of silver to pay for 1 ounce of gold. We've seen that trend starting to be broken, and we've seen a strong move in silver over the past couple of months. So it could indicate that silver may potentially start to move back down towards 65 ounces to 1 ounce of gold. That's quite a significant outperformance if that's going to happen, and that means that if we believe that there's an upside story for gold, then potentially silver could be performing even better over the coming months and couple of years. So that's one we're keeping a close eye on. But just like gold, we're also seeing a phenomenal increase in the number of speculative buyers of silver. And again, these have to be reduced at the moment. And from a trading perspective, you have to be aware that silver is less liquid than gold. So if you have a big build-up in interest and it suddenly has to be corrected, then it does have quite a big impact on price. So you can see days where if gold falls 1%, you may see silver fall 2 or 3%. And that's just the risk with silver. It is a smaller market, so you have more volatility than you often find in something like gold. But let's go back to gold. Again, we got the bull and the bear. The bull is the key one that I mentioned, the fact that we still have negative bond yields. As long as the other central banks, apart from the FMC, continue to keep very loose monetary policies, as long as the ECB in Europe continues to buy up bonds, then you don't have the opportunity cost of looking for alternatives. And one of these alternatives at the moment is gold and silver, for that matter. We've seen a little bit of change over the last week, and that's also creating some headwinds just in the near term. The fact that even though the market's actually now starting to get used to the fact that U.S. interest rates probably will go up, and we've seen stock markets go up as well. And when stock markets go up, the need for alternatives reduces. But I think still these are only drivers that will have an impact in the short term. And the fact that the oil prices has been moving up, commodity prices have started to bottom and starting to move up, will also indicate that we are starting to see some inflation. We could see inflationary pressure start to return over the coming months and years. And obviously, inflation is gold's best friend, so that could make a return. Equity market turmoil is another one. If we do see that come back, then again gold will support it. The downside risks are the main downside risk is the dollar. If we see a strong return or strong demand for the dollar again and it starts to strengthen, then gold will be struggling. But then if gold is struggling because the dollar is going up, then there are other alternatives. Gold these days is probably one of the most diversified investments that you can have, because you can trade gold as futures, as CFDs, as spot. You can trade against different currencies. And what you have to remember, if you buy gold, you're also selling a currency, because gold is, to a certain extent, a semi-currency. We normally price gold in dollars, so if you're buying gold, you're actually selling the dollar at the same time. So when the dollar go down, it's good for gold. When dollar go up, it's bad for gold. But if you think the dollar is going to go up because maybe the euro is going to go down, or the yen is going to go down, or maybe the Chinese yuan is going to go down, then you should not be long gold against the dollar. You should be long gold against the yen or the euro or the Chinese yuan. And these can all be traded on platforms these days. You don't have to go out and buy gold against the dollar and then go in the currency markets and sell the dollar and buy the dollar back and sell one of the currencies. You can buy that as a single trade. And that makes the diversification of gold quite high, or the availability of markets. So that's also something to a gold investor should not just blindly look at gold as the price we see today, 1,205, which is priced in dollars. There might be a different currency that's more attractive, because you need to have a view on gold, but you also need to have a view on the dollar. And if your view on the dollar changes towards a stronger dollar, then you need to look for another currency to be short of against a long position in gold. So just to be aware. What else have we got? So, but I think you can all see them here. But the coming couple of months, June and July, is seasonally quite weak for demand, for physical demand, before it picks up into the autumn, when we see the Indian festive seasons coming in. Later in the year, we see Chinese buying ahead of their new year. So if we should see some weakness in gold, it will probably be over the next couple of months. Again, looking at the chart, a little bit technical, but when we see big moves and you see retracements like we're seeing at the moment, that's very it's commonly used in the market that you look for retracement levels. It's Fibonacci levels, as they're also called. We had the big rally from the end of last year up until till March, April, and since then the market started to move down. When the market starts to correct, the market starts to look for how far can it correct. And what you normally say is that if it corrects 0.382 of the rally, that's okay. That's 1205. That's basically where we are right now. So a move down to 1205, that's perfectly normal. It's very healthy, because we've seen the market go a little bit stale. So down to 1205 is no problem. A 50% correction is indicating that the pro trend that we say, when the market is in an upward trend, if it corrects more 50% of the rally, then the pro trend starts to become a little bit of then nervousness starts to come in. But it really needs to break the 61.8%, which is 1145, before you can say, well, the bull market might be over and we need to rethink what we do with gold. So we are into a very challenging period right now. We have found some support around 1205 on Friday. Today we've been down to 1200, but really the key levels to look for is between 1145 and 1175. We are seeing long-term investors at the moment using this as a buying opportunity, but they're also aware that if we make it below 1145, then we have to accept a longer period of consolidation. Likewise on the upside, if we can break it back above 1205, I think really 1305, then I think 1380 could be the next target for gold, and that's really where we see the market is over the coming 12 months is that it's going. We have a target for this year of 1250. We had that at the beginning of the year, so we were a bit more positive than the rest of the guys looking for lower prices. We had 1250. We reached it very quickly. We haven't changed the upside call at the moment, because I think after having rallied by 20% within a few weeks, then we need a longer period of consolidation. So The next couple of months, especially up to the next US central bank meeting, is going to be very important. It's going to be important in terms of how low we fall before we get into the meeting, because quite often in these markets, from a trading perspective, a lot of the movements in the markets are often priced in before the actual event. So you'll find that if market is worried about hiking rates, then they'll position themselves before we see the event, and once the event actually occurs, then we actually see the markets start to see the market recover again. So the next couple of months is going to be quite critical. But overall, keep an eye, 1145, 1175, the key area that we need to hold. But our overall view is that gold will go up again because we have this global situation with negative bond yields, which is adding some support. And that is what I have to say. I don't know if we have time for questions. Otherwise, as I said, I will be around. I think we're running out of time anyway, so we've got 4 minutes to the next speaker. So you can, if you want to follow our updates, we have tradingfloor.com, which is our community site where we publish posts on foreign exchange, commodities, equities. Otherwise, you can follow me on Twitter, where I'm very active on providing news updates on gold, oil, and what else is going on in commodities. So I'll say shukran, and thank you very much for listening, and thank you.
يعطيكم العافية. هيك المحاضرات خلصت، بس إذا عندكم أي استفسار عن محاضرة الساكسو بانك بإمكانكم تتفضلوا على البوث.